Here we go. Hopefully 30 minutes, 45 minutes. We've got a Q&A session at the end. A bit of housekeeping before we crack on. There's a Q&A button at the bottom of the screen. Write your questions in there, and Ashley at the end will then collate them and ask me the questions, which makes it a lot easier for me than having to try and do this as I go along. If anyone wants to ask a question that's already been asked, then just put the thumbs up so we can make sure that's a priority. So, quick background, Raffingers, for those who don't know who we are, and myself, our values, these are our 5 core values that we live and breathe within the practice. We make a positive impact, and hopefully a lot of these 5 core values we're covering in these presentations, and we've obviously done quite a lot during the COVID, and obviously as we come out of COVID, we are very wary of helping as many businesses as possible, and this is really the start of it. So we make a positive impact, we get it done, deliver to a high standard, always make time and dare to be bold, and obviously we do give the best business and accounting advice in the game, hopefully. We think big, just covering off some of our core services that we provide. They include strategic meetings and advice, Profit First, which is our sort of cash flow management system. Anybody wants more information, Profit First, myself and Paul, one of the partners, we're certified Profit First professionals. If you're interested, read the book, just Google Profit First and you'll find the book really, really good. And look out for some further webinars about that. Cash flow management, wealth management, we provide helping protect the assets that you've got, and looking at exit planning, retirement planning, corporate finance, tax planning, forecasting. There's loads there. And obviously at the bottom, we do all the compliance stuff that you'd expect from a firm of accountants. Forecasting and management, I will obviously cover in this webinar as well. Myself, founder partner, one of the founder partners at Raffingers, as you can see, heavily involved in Profit First, profit improvement, business planning, cash flow, and 32 years experience working in practice. I know I don't look young enough, but ho-ho, must be the beard that's making me look 20 years older, but ho-hum. Right, so let's get cracking on. Now, a long slide here, but I think this is very topical, and a lot of businesses that I speak to and advise and sit with, these are sort of the 8 common mistakes that small business owners make when I speak to them, or if they get into any trouble. The first is they don't plan. Every business should be planning ahead. Whilst COVID has given people a little bit more time, they have actually gone ahead and started planning for the future, looking for the next 12 months, 3-year, 5-year plans and so forth. It's critical for the success of a business, and you'll see that a lot of this webinar is all about planning and how we can help you plan your business. Businesses don't know or even understand their numbers, which shouldn't really be an excuse anymore with the invent of cloud bookkeeping systems and online banking. Businesses should know their numbers every day and understand their numbers. So where they don't understand their numbers, it does cause issues going forward. Number 3 is great, that they think they can play every role and don't have the right team at the right time. So it's really important that you have you recognize the need to bring in experts or outside assistance when you're not able to do everything in your business, and it's knowing at the right time to bring in the right people to really move your business to the next level. I think if you look around on most successful businesses, they've got a really strong team around them. I'm sure Alan Sugar doesn't do his bookkeeping or his VAT returns. I'm sure he's got good finance people or goes out looking for properties. So the same thing, you need to get good people around you. Number 4, run out of cash. Cash is king, as we all know. Forecasting and keeping an eye on the cash within the business is so important. Profit First is such a good system to implement to keep you an eye on the cash within the business, especially if you are reliant on looking at your bank balance every day, rather than looking at forecasting or any sort of software tools. So that's what a big mistake that people do. They may be generating lots of sales and the salesmen are doing great stuff, but maybe there's issues with the credit control or no one's really chasing the cash. You need cash. Lack of systems or fail to upgrade as they grow. So you need systems in place that people can follow, and it's repeatable, consistent results that the team can always follow. So how do we do it here as a simple way to do that? And again, there's great software out there to enable you to implement systems. We use Suite Process within our practice, and it's really good way to look at your existing systems. And then whilst you do that, you can look at maybe weaknesses in the system and look at to upgrade or improve those systems as well. So really, really important to systemize as much as you can. Number 6, not knowing their customers, what they want and what they value. You really do need to know your customer base, your ideal client, your ideal target, and that enables the marketing team or you to go out and target those businesses. If you're trying to catch everybody, then you're not going to be as successful. So you need to understand what the customer's issues are, their fears and their wants. So really important as from a marketing point of view to know about your customers and really get under the bonnet and so you know who you're trying to attract. So a lot of businesses ignore culture, they ignore core values and brand, all that fluffy stuff that we say is really important. If you can put in a really good culture and the core values, example, the 5 that I showed you before, and you live and breathe those core values, it does make such a big difference to the team, to the outside world, and really does move you to the next level. And number 8, the final one, is failure to implement. FTI, fail to implement. Great, we do all this great stuff and we know we should be doing it, but because there's only so many hours in a day, nothing gets done. You're not accountable to anybody. A lot of people fear of failure, of testing things that they don't want to fail, and not sure how to then come back from that. And also you need to measure and monitor and put plans in place. So I think number 8, it covers all of the other 7, and it's really important that things actually do get put into place. So they're the 8 biggest mistakes. And what we want to try and show you is what a business needs to do to avoid those mistakes. So we know what those 8 mistakes are. How can we try and make sure that we don't fall into that trap? So you need to understand your key 7 numbers. And I'm going to show you shortly what those 7 key numbers are in your business. And you need to understand them, how they work, and how the small changes can make big differences. So we need to show visually what those small changes make and what those key drivers do to your profit and cash. If you know what the effect is, then you will put things in place because you know you've got something to aim for. You need to create an action plan. You need to write down your action plan. If it's just in your head, things don't get done. You write it down, you're made accountable to somebody, things will get done. So you need to help resolve your pains. So you look in your business, maybe your debtor days are too high. So what do? Right, we need to put in a debtor collection system. We need to resolve those issues, those big issues that will make a big difference to the business. Also, you need to understand cloud apps. Now, the cloud apps, so many businesses now are running through the cloud. If it's not their software, bookkeeping software, it's their maybe CRM, it's their in-house backup system. Most software now in the cloud. You need to know what's around in the market to help you improve your systems, help you improve your efficiencies, and help improve your business growth. You need to be made accountable. So I've touched on that last time. If you're made accountable, things will get done. And I always compare business to the sports world, where most most sports people have sports coaches. Why would they have sports coaches? Because they're accountable to that sports coach. That sports coach will push them, will help them, will nurture them, and the same in the business world. I think it's very common in the States to have mentors and coaches in the business world, but in the UK we don't seem to do that. And I always think that we should be doing that. If it's not with accountants, it's with your mentors, it's with somebody, even a friend who can maybe help you be made accountable. So I think that's really important, and you'll see a big difference as well with that. You need to prepare simple financial plans. It's better to have some form of financial plan than no plan at all. Again, I'll show you how we can help you put together simple financial plans by using maybe just software, or you can even use Excel. You need to at least start somewhere. So simple financial plans, really important. And you need to grow, you need to scale and grow sustainably. So you need to look to see how the business can grow with its own momentum. And again, a lot of everything that we're doing here will enable that to happen. So what are the 7 key numbers? So the 7 key numbers in a business. So we found that their revenue growth, gross profit percentage, and I'll explain these figures later on, operating profit percentage, the revenue per employee, how efficient your employees are, what your core cash target is, what is our target that what cash should we be having in the business, what our cash days are, which is basically the difference between how quickly people are paying us and how quick we were paying our suppliers, what the return is on our business, how if we weren't in business, if we were investing our time and money elsewhere, what return would that be? So that is a good benchmark to how successful the business is. So what we do, we've used a bit of software, a tool to help us look at these figures in a little bit more detail. And what I'm going to do with the beauty of technology is show you a bit of software that we use called Clarity. Now, Clarity is basically we use the bookkeeping system, and this is great using cloud technology. So what it will do, it will suck the information from QuickBooks Online or Xero or any cloud-based bookkeeping system straight into this. So you don't have to key anything in. And basically what it will do, it will look at your 7 key numbers in your business, which is a great starting point. And that's all we're doing now, is looking at where we are today. And then I'll show you what we want to do looking forward and what the effects are of making small changes to these numbers. And as you can see here, we've got those 7 key numbers here and the business return at the bottom. It's quite nice that you can flick these and it'll show you how we got to these figures. And this is some live data from a client that we're helping, obviously called the Avengers Limited. And look at it, you can see all these figures comparing where we are now and the growth or the reduction in the previous year. So this is our starting point, and you can see we've got £2 in the bank and we should be hitting £77,000. How do we get to that 77,000 cash target? And our bank has worsened by £27,000 compared to the previous year. Again, the same with the revenue per employee is got worse. The employees aren't generating as much revenue as the previous year, which is why all of the things are in red, which are problems, and the ones in greens are doing well. So the revenue actually went up for this client by 7%, but the GP went down slightly and we've got less cash. So how comes that's happened? So it's just a really good talking point of where we are now. Now, the beauty is what we can do in the future. And this is where I want to show you the effect of making small changes. Now, we can use this scale of moving across. And as you can see, if we increase the 5 levers of success, and the 5 levers of success, I'll go talk about them in a minute. If I can increase everything by 5%, I put an extra 75,000 on the profit and 76 cash in my bank account, which I think we can all agree is a great thing to do and to aim for. However, it's not going to be practical to have 5% across the board on these 5 levers. So what we're going to do is maybe, okay, we can do 5% growth, revenue growth. I think if we can increase our prices by maybe 2 or 3% and also maybe get more sales in, yeah, I think we can achieve 5% revenue growth. And this is the difference here. But we might struggle with a gross profit percentage. It could be that we find it really difficult to increase our GP by 5% from 37 to nearly 39 because maybe our suppliers aren't putting up their prices. It's hard to find anything that's cheaper. So we might agree that rather than 5%, we're only going to increase it by 2%. And the same going forward, your operating profit. So how can we get our operating profit increase from 12.7 to 13.8? We look at our overheads. We can cost cut as much as we possibly can. And we've already done that exercise last year. So we're really only going to be maybe achieve 3% increase this year. So that's the difference going forward. Revenue by employee. How efficient are our employees? Can we maximize them even more? Again, maybe 5% might be about right. So we'll leave it at 5%. Cash days is pretty good anyway. We got down from 8 days. If we can get it down to 7.5, I think that's quite achievable by reviewing our credit control procedures or paying our suppliers a little bit later than we normally would. And then if you go back up by making those small changes, can you see that the profit and the cash has gone down slightly? And that's all we're trying to do is just look at those and make those small changes. Now, this is just a great way to show the effect of looking at them. And the next step is to write, how do we actually then go and increase our revenue by 5%? How do we do all of this? I can see that you've showed us the impact on our profit and cash, but great, how do we actually go about it? So if I just go back to the presentation, there will be ideas of how we can actually then tweak those figures. Now, the idea with this is that I've put a lot of information on these slides. If you can just maybe choose 1 or 2, maybe from each slide, or just concentrate on, right, okay, we're going to just increase our revenue growth. How do we do that? And then worry about the other drivers later on, and just maybe pick a couple of things out, and I think it will make a big difference. So raising prices is one way, obviously, to increase your revenue growth. And here are some tips on how you actually go about raising your prices. So you need to study what your competitors are doing in the marketplace. How have their prices changed in the past few years? If everyone is doing it, then your customers will get used to it. If, I don't know, Sky, Netflix, Amazon Prime, all of them are putting their prices up, then customer suppliers in that field won't have an issue because it's just the norm. But if they're not, then you've got to then offer something unique that your competitors are not providing. Do explain your reasons. Simply share the basics. Why you're increasing prices? Is it that your overheads, the costs are going up and you need to pass that on, and you need to focus on the benefits to your customers, which is really important. When you do increase your prices, expect to lose some customers, but you hope to gain some at the same time. And normally you will find that you will lose those customers that you want to go anyway, who are usually cause you huge problems anyway. And we call them BMWs, bitches, moaners and whingers. I think it's a great example to show some of those customers that you don't mind losing. Don't be sneaky. You must give plenty of notice. Don't just sneak in an invoice price increase without telling everybody, because that will really backfire. And don't apologize. You need to come across confident, and you got to really focus on the benefits to the customer. So that's a great, I think, slide of how you go about increasing your prices. How do you increase your volume? So another way to increase your revenue growth, increasing your volume. If you know the key qualities and differentiators of your product, as you're looking to move more units, you need to have a rock solid understanding of your products, key features and differentiating properties. So you need to be able to sell and cross-sell to your existing customers. Keep your customer benefits front and center. The customer's always thinking, what's in it for me? So if you can demonstrate that you are saving time or improving the quality of the life in some way, then they will buy more from you. You need to thoroughly qualify your prospects. You want to reach those who are the best fit for your product, more likely to buy from you. There's no point trying to hit the whole market and expect everyone to buy from you. If you can qualify your prospects or target your products and services to your ideal client, you're more likely to convert. If you understand your customers' pain points, when you understand what their pain points are, you can then really target your product to them to obviously relieve them of their pain points. And I think that's really important as well. And it's the right solution to your customer. If you work closely with your marketing team, ensure the right leads are being achieved and they're aware of sales targets. Obviously, goes without saying. Motivating and incentivize your sales reps or generate competition. Really important to try and get a team culture going and just trying to increase those sales. Maybe look at customer rewards. Very popular now. Seeing so many restaurants now doing multiple purchases, loyalty cards, and a referral system. And I think that works really well. And focus on top buyers. So look at your customers and maybe concentrate on those top customers who are buying from you regularly. Can you cross-sell? Can you sell more products to them? And so forth. So there's some just key points to how to increase your volumes. So we're looking at margins. So we was looking at the gross profit percentage, and sometimes that's hard to do. So we've already looked at increasing the sales and the volumes. How can we look at then looking at our cost base, our cost of goods sold? So the efficiency of sales, relationship manager, and marketing teams, we've already talked about that in the previous slide. So bringing in new business costs money, whether that be marketing spend or the salary and commission of a salesperson. You need to first of all have a good idea what this is costing you. What is the cost of acquiring one new customer? I think research has shown, I think 7 times more expensive to bring in a new customer than it is to sell to your existing customers. So are you putting all your efforts and all your money into gaining new clients and ignoring your existing customers? Should you maybe change your tact and look at improving your product development or new lines and hitting your existing customers first, rather than going out and attracting those new ones? So if you are going out looking at your leads, then focus on the existing leads, more likely to come on board if their circumstances have changed. So maybe there was a lead that you've were going for 6 months ago. Make sure that those leads are continuously being looked after, maybe continuously contact them to maybe see if maybe it could be a timing issue. A lot of it is timing, that they're not ready to buy from you 6 months, but now they are ready to buy from you. In great examples in our practice, we've had people come back years later after our first lead and, oh, we're ready to now buy from you and use your services. So that, I think that's really important. So you've done a lot of work to get those existing leads in the first place. Look at your commission structure. Does it work? Does it incentivize your sales team to go out looking for new leads? Make sure they're selling the right products to the right customers, obviously, goes without saying. Product and development, increasing your offering, which can be sold to existing customers, talked about that. Market development, finding new markets for your existing offering. I think through COVID, a lot of people have looked at their existing business and where they've been suffering. They've looked at new markets, new products, how they can increase their sales that way. And have you reviewed the price you pay as well? Have you reviewed the cost that you spend on your suppliers recently? Have you gone to the market and did a price comparison for your suppliers? When was the last time you've done that? I think that's really important as well. So that's one way of increasing your margins. Another way, so this is to do with your increasing your net profit percentage. Obviously, we need to reduce overheads. When was the last time you reviewed all your bank statements and reviewed every cost that is going out of your business? Set up a spreadsheet, really basic, with 3 columns. And I think a lot of people did this through COVID and really looked at their supply list. So on your spreadsheet with the 3 columns, First one, is it necessary? Is not needed? How many people have subscriptions that they haven't reviewed for a while? Costs that go out that they haven't got a clue and it's just been going forever. So this will then highlight any unnecessary costs that are going out. Replace. So you then look at how you can replace some of those that you actually do need to keep going. Can they be replaced with a cheap alternative without affecting the service received? So you've just got to be careful that if you do look at alternatives, that the service is not going to, or the quality is not going to suffer because you've gone for the cheapest product out there. So that's really important. And obviously look at the profit. If it directly generates profit and cannot be changed, then you might be stuck with it and you need to just stay with it. So they're a really good way. And if you want to ask me at the end, I can then send you sort of a spreadsheet that I've put together, a template to maybe start getting you to think about reducing your overheads. Again, there's some great bits of software out there. We've just teamed up with an app called Reducer that will go in and look at all your utility bills, your stationery bills, all your main large overheads, and review them without you doing anything, and recommend cheap alternatives. I think that's great. When you don't have to do any of the work. Again, if you need any information about Reducer, let me know. Great bit of software. And then we're looking at cash days. So increasing our cash days, reducing our cash days, i.e. keeping more money in the business. A few things we need to look at, which is the accounts receivable days, i.e. your debtor days, how quickly your customers pay you. Again, having a plan or strategy in place can save you getting into a mess. How many times people contact me when sometimes it's too late because the debtor days are going up, people aren't paying them. It's mainly because they haven't got a dedicated credit controller. It's normally left to last, and it's normally left to when there's no cash in the bank, and sometimes that's too late. So we've got to have a clear strategy regarding credit control. Review your system, which is about what we discussed at the beginning about systemizing everything. What is your credit control system look like now? Could it be improved? Can it be tweaked? And using maybe apps. Chaser is a great app that we use and recommend to clients, that automatically emails get sent out to clients chasing for money, and it looks like it's come from a real person and not from a computer. And the results have been really impressive. We're using a bit of software, and having that system in place is really important. So some points to consider: focus what you can control, embrace tech. Chaser, for example, be nice, send your invoice to the right person. How many times the invoice gets missing or gets to the wrong department? Only give credit to the right person. 30 days is a long time. Why 30 days? Why not reduce it to 14 days? Can you bring in your money even quicker? And can you implement late fees and incentives? I know some clients who will give a 5% payment discount if it's paid within 7 days. If it's over 90 days, do they charge a late fee penalty? All of that stuff. Have you looked at maybe using factoring, invoice discounting to bring in cash quicker? And that market is now really open, and a lot of people use just one-off invoice and discounting, which is really without tying into contracts, is a good way to get money into the business really quickly. So you need to review that. If you know your debtor days are increasing, or it's not under control and it's not how it should be, then focus on that and look at ways that you can reduce that. I'm not going to spend too long on inventory, because I think people who hold stock are very aware of the inventory turnover figures, and it's really important that the goal for that company is to hold enough stock to meet its clients' orders continuously, so they're not short of stock, but at the same time they're not holding too much and all the cash is tied up in the stock. And that's where a lot of businesses get into trouble because they just can't turn the stock quickly into cash. So if you have got stock, then I think there's 2 or 3 key ratios and figures that you've got to keep an eye on within the business. And inventory turnover figures is really important. A good example there, if a decrease in inventory turnover is showing that is not converting its inventory into cash as quick as possible, and if the trend is that that figure is getting lower and lower and lower, then there's an issue, and you need to review obviously the way you're buying stock. So I won't go too much onto that. And again, other people, you look at days to sell inventory, another ratio that people look at how many days it takes to turn that stock into cash. And I think the last 2 points are quite important. To reduce its inventory period, you need to streamline the order to delivery process. If we can all copy the way Amazon do it, then I think we'll all be very, very rich and millionaires. So look at the way they turn it around so quickly. If there's issues with delivery times, there are issues with returns or the quality of the product that goes out, you need to really get into the detail and see why the inventory period is maybe too long in your business. So that's talking about inventory and stock, and obviously days payable. So days payable outstanding. So basically this is very simple. This is the amount of time it takes you to pay your suppliers. So again, if you can make some really small tweaks to getting your customers to pay you quicker, and also you're maybe paying your suppliers a little bit later, obviously with their agreement, then that's going to make an impact, a positive impact on your cash in your business. Who's phoning? I said no one should be phoning. Oh, sorry about that, guys. Didn't expect the phone to ring. Sorry. Oh, now I've got the answer machine going. Oh, really? Anyway, sorry about that. Anyway, number 7. So number 8. So they're the steps to take to try and make those improvements to those key success drivers. So if you go back, let me go back to these. Yeah. So you might now it might be a little bit clearer how we can actually improve the growth. So yeah, great. We can, if we make those changes that I've gone through in my in the slides. Yeah, I think we can hit 5% or even 10% if we do things properly. And yes, we're going to take some of the points on the gross profit, look at our suppliers. So all of those ideas will have a positive impact on these 7 figures within the business. So what I want to do now is talk about forecasting, cash flow forecasting. So together with making those tweaks to the numbers, I want to try and get everybody to understand how important this is. So why should you prepare a cash flow forecast? So the first one is quite obvious, but it provides a clear path to achieve your goals. So it's not enough to know you want to take good steps every day. You need to know exactly which steps to take to get where you want to go. So if you want to be a business that's turning over £2 million with £500,000 profit, whatever, and with 20 staff, then you've got to know how you're going to get there. And the financial forecast will make you do that. It will make you very aware of what's needed, financial, whether you need finance, whether you need to bring investors in, whether there's peaks and troughs in the business, where there's problems with the cash flow. You need to have a financial forecast, and every business should have a forecast. And I'll explain and show you what we do to help our clients think about this and put things in place. It creates trust and confidence in raising funds. If you need to go to the bank or you need to go to investors, if you've got forecasts that you can produce straight away and even have those forecasts, previous forecasts against actual figures, it just gives confidence that you know what you're talking about and able to access access those funds going forward. And it tells you what resources you need and when. One of the major factors of inefficiency within a company is failure to know exactly what resources are needed at any given time. And this gets around that problem because you know exactly where you're going. There's no point looking at the past. You can't affect what's happened, but you can affect what's going to happen in the future. Really important to have cash flow forecasts. So it enables you to grow. It will obviously show any cash gaps and surpluses before they happen. Gets you on top of your accounts receivable because it really does focus your mind on, okay, we need to get more cash in. And obviously you can track your spending and staying with the budget. And this is a great sort of example, quite simple, where the cash gap is, especially for somebody with stock, of how long it takes from the money, from the goods being received in the warehouse to when it's received from the customer, and it takes 75 days for that whole cycle to happen. So if you can make changes all the way through and make it more efficient and reduce those days, it makes a positive impact on your cash flow. And also, once you have put together your forecast, you think, oh great, yeah, done that job, I don't need to do it anymore, Lee can stop chasing me and nagging me to do my forecast. You've got to maintain it. You can't just leave it and forget about it. You've got to maintain and keep your cash flow projections going on a regular basis. Why do you need to do that? Because you need to identify cash shortfalls and address those issues immediately. You'll see it a lot quicker with your forecast than by the time it hits your bank account and you realize, oh crap, I've run out of money. Obviously, more important now than ever that people have taken bounce back loans, maybe they've taken C-bills loans out, they've deferred their VAT, they've deferred their personal tax, maybe their rent's not being paid. All of that you need to then factor in and see if the business can afford to pay that over the next 12 months, or however long you want to do your forecast over. You track your payments and make payments never early but always on time. And it's you want to have to and work for your business and not the other way around. Again, you need to know your customers. Are they always paying you late? It will highlight any bad customers. It will also highlight maybe changes that you need to make to your customer base. If they're forever paying you late, it's going to cause you a problem, and you need to address that. And you'll be able to address it a lot quicker if you know what's going to happen. You can see your trends. You can adapt your workflow, make better decisions before heading into a time of unusual activity. Really important as well. You can really see what trends are happening. You can build up cash reserves. If you're consistently building up your cash, can you make short-term investments and maybe invest it in, I know, machinery or stock or new employees or anything. So I think, again, you can see how quickly those cash reserves build up. And a lot of this is very much around the profit first, of moving money out of your main bank account and putting it into sort of designated buckets. And it really does make a big difference, especially if you've got plans for growth and investment and to buy and purchase any machinery going forward. Again, you can identify growth opportunities once you've built up the cash reserves. So obviously pre-COVID, it would have been great if people had built up 2 or 3 months worth of cash reserves to cover working capital and things like that. So what we try to do is build up cash reserves and then look to grow on the back of that. So you've got sort of a funds there if things don't work out. Again, it's really important, as opposed to just running in blind. Yeah, we want to grow without really having a backup of knowing where the cash is. And obviously it reduces stress. If you can clearly see what's going on with the money, when it's hitting your bank account, when the money's going to be tied up, when it is going to have shortfalls and so forth and so forth, it just gives you confidence to run in the business, and you knowing that that cash is not an issue. So again, those are 7 really good key reasons to maintain your cash flow projections. And now what we're going to do is look at within the software, there's a really simple, nice financial plan that we've started to show clients. That's typical, isn't it? That I've now logged out. So the financial plan here, now this is really important because this is bringing information straight from Xero or QuickBooks Online. From your cloud-based system, it's taken all the figures, the previous year's figures, and it's forecasting what it thinks is going to be the next 12 months. Now, as you can see, this is a very basic forecast because no one business has consistent sales like that or costs across the next 12 months. But what it does, this plan just gets you to think about the future, gets you to think about what your business is going to look like in the next 12 months. And what you can do with this nice bit of software, you can actually change it. You can have a fixed amount, you can increase it by 5% per month, or you can go through and adjust each month as you see fit. So you can adjust these going forward. And the idea is to look at where the business is going to grow. And you can see how this is using the figures within the summary. So we've said that we're going to increase the revenue by 5% and these other percentage increases. And what it's done is it's forecasted based on those percentages that we did previously. And it will give you like, I don't know, an incentive to look and yeah, I can see that. And then I think the beauty of then, once you've had done these forecasts, is you can have your financial plan. You can now compare what your plan was against your actual. So if I change this to last month, I can see that our plan was 47,000 sales. We actually hit 176,000. Wow, we had a great month. But what about the rest of the costs? Yeah. Do any of these figures jump out of any differences? And obviously the negatives are not very things that we need to look into. So the beauty of it is that we can plan and we can compare our forecast to actually what's happened. And we've got year-to-date figures as well, rather than monthly. And we can actually do it quarterly as well if we want to. So with a quarter to January, if I change it to quarter to November 20, oh, can't do them here. So you can, so you can change it quarterlies as well, then and look at your previous quarters as well. And you can download these into Excel and you can maybe manipulate it there. If this is not ideal from, if you're not too familiar with software, then just use it on Excel. Most people now can use Excel. Just having something there to look at and have a plan is better than having no plans, because you are then looking at what's going ahead in the future. So they're sort of, that's why I think forecasting and planning is so important. So that's really it, so that you can see the effect of those small changes can have in your business and why it's so important, especially now going forward for 2021, 22, having a plan put in place, a financial plan. We're here to help you put together those plans, even if it's just to maybe cast an eye over your financial plan, just to make sure, sense check it even, to make sure that you think you're on track to what you're doing it properly on Excel. We can do that. So, Ashley, are you there? Can you come in? Is that possible?
Hiya.
Oh, well done. Great.
I'm just going to pop my video off as well, so I don't just look like a weird voice floating in. Hi, everybody. Thanks, Lee, very much for the webinar. I think it was really useful. We've had a couple of questions in, and I've also got some questions I think would be useful for you to answer. So Samantha asked, prior to showing the software that we've got, the Looking Forward with Clarity software, what programs we would recommend for forecasts. So obviously we can run data through our Clarity software, but are there any other software that you would recommend, Xero add-ons or anything we can help with outside of that?
Yeah, so apart from Excel, if you're a Xero user, in the marketplace within the Xero website, there's abundant of software out there that will help you with your forecasting. I think it's important to decide if you want how advanced you want your forecasting. If it's just a daily forecasting tool, then I think just doing it on Excel yourself is great. If you want it more advanced, maybe, I don't know, in the next month to 6 weeks, there's some great bits called Fluidly online. You can use Futurely, which is another great bit of software. And then it depends if you want to really go advanced and like 3-way forecasting, which is your P&L, your profit and loss, your cash flow and your balance sheet, maybe because you want funding or investors to come in. Then again, there's Spotlight, there's Futurely, there's so many out there that can perform it. And even we've got some sort of simple Excel spreadsheets that can do the more complicated stuff as well. But it's a shame not to use the software that's out there, because you can create some great reports and compare your actuals as well, which is really important to what you forecasted, like I showed you on that software.
And if one of our listeners wants us to run their data through the software that you demonstrated, how easy is it for us to do that, and how quickly can we run their data through that?
Yeah, so if you're on Xero QuickBooks Online, literally takes 5 or 10 minutes to input that, or not input, but to link the information. A bit longer if you don't use a cloud-based system, but we can still generate those figures from non-cloud-based systems. So the example I showed you, it took me, I don't know, 15 minutes to input the information from previous year's accounts. But the idea is just to get the information on there and start talking about the business, start looking at the growth, start looking at the overheads. I think it's not the end all and be all of having those figures 100% accurate. It's just makes you start looking at your business slightly differently to you have been up till now.
Definitely. And you mentioned, obviously, if they're on a cloud-based system, that it's pretty easy to run their system through. Would you say that to have a really, really good overview of all of your 7 key drivers and your numbers, you should really be on a cloud-based system anyway, and start to think about moving over to a cloud-based system? Or do you think the traditional accounting systems are still efficient?
Yeah, to be honest, everybody now within business should be using the latest technology. So everyone should be using a cloud-based bookkeeping system, linking their bank accounts straight into the bookkeeping system. The bank feeds are kicking in straight away. You've got real-time information on your mobile devices. You can raise invoices quickly. You can chase for payment quicker. The whole efficiency is there. I'd say 80% of our clients now are using some form of cloud-based software. And it's so important. And also going forward, making tax digital. So I know things have been delayed, but it's only a matter of time, and it will come in that you're going to have to report all your accounts and bookkeeping information via your software package. Eventually, they're going to want that information quarterly rather than annually. So you're going to have to embrace it sooner or later. And so why not do it now?
No, definitely. That's all the questions that I've got. If anyone has any more questions, obviously feel free to quickly pop them in the Q&A section. Otherwise, I think that's pretty much a wrap. Lee, do you have any additional comments?
No, I think that's it. If anybody wants to contact me about maybe some of the things I was talking about, like the overheads template, maybe the cash flow templates that we use in Excel, even if you want to run those figures through that bit of software, more than willing to have a go and have a chat with you, if that's what you want, and just maybe be there for a bit of support. Oh, I think the Q&A's just come in.
Definitely, yeah, there has been. So Samantha's asked if there are any costs to do the forecasts with us. And that really depends on the level of forecast required.
Yeah. So yeah, if you want to do it, yeah, we've got pricing structure where if it's just come from zero and we've just carried it forward for a year without really doing anything exciting to those figures, it's not going to cost too much compared to maybe a three-way forecast and maybe doing 2 or 3 years figures. Then yeah, there's going to be costs involved, but we always try and give an idea of what those costs will be beforehand. Yeah, every business is so different as well. It really is.
And as Lee mentioned, we do have Excel spreadsheets to do kind of more simple, very simple forecasts. So what we will be doing is after this webinar, you'll all receive an email with a recording of the webinar, the slides, and I'll provide some resources which will include that simple forecast template. It might be a good idea, if it is something you're interested in, is to play with the simple forecast, see how useful you find having those kind of that awareness of your figures, and then when you realize that it's important, get in touch with us if you want a more sophisticated version.
Yeah, and the really important point of doing your forecast is that you need to then compare those forecasts to the actual figures. So there's no point just doing that and then leaving it, because you need to then see where there's issues or there's things that need tweaking. So it's a continuous process all the time, which that's why the software does help, where you're integrating it with QuickBooks or Cashflow or QBO, and it's picking those actual figures and comparing it for you without really doing any works. And then it leaves you to then make those decisions and try and improve the business. That's really important. I think that is actually so key.
Definitely.
Another question there, was that answered?
Right, that's everything answered. As I mentioned, everybody, please feel free to drop us an email, either directly to myself or Lee, or through info@raffingers.co.uk. Check out our website. There are so many free resources, templates. I think even the cash flow forecast template is on our website. You just have to sign up to the Raffingers tribe to download it.
Should we do a plug for the budget on Wednesday?
Yes, we should, Lee. Good thinking. We are covering the budget live on our social channels on the 3rd, but first thing on the morning of the 4th, we are hosting a live panelist discussion with, I think it's 9 of the partners, hosted by Neil, who is our tax specialist partner. He's also an ex-HMRC officer, so he's got so much knowledge about all things kind of tax and that side of things. So we'll be doing a live panelist discussion talking about all of what came out of the budget. It's called What's in the Briefcase, where we will be unpacking, as one of the partners you did just said, unpacking the red briefcase throughout that morning. So I will send that link in the email follow-up as well.
Cool. Thank you. Thanks, everybody. Have a good day. Thank you. Bye-bye.